In this video, we will discuss the potential dangers of a rising interest rate environment for stocks, specifically in today's stock market. While markets are generally considered efficient and should price in all public information, there are several factors that suggest otherwise. We will explore why rising interest rates can be detrimental to stock valuations and why investors should be cautious in such an environment. Valuations and interest rates. Historically, there has been a relationship between interest rates and stock valuations. When interest rates rise, stock valuations tend to be pushed down. Currently, the valuation of the standard 60/40 portfolio is at a 130-year high, indicating that stocks are still priced at levels seen when interest rates were much lower. This suggests that the market may not be fully accounting for the impact of rising interest rates on stock prices. The money printer analogy. To understand the relationship between bond prices and interest rates, we can use the analogy of a money printer. If you had a money printer that consistently printed $1 every year, how much would you be willing to pay for it? The answer depends on your desired return on investment. Similarly, the price of a bond is determined by the interest rate it pays. As interest rates rise, the price of bonds decreases, making them more attractive compared to stocks. Active versus passive investing. Passive investing, where investors blindly invest in stock market indexes, has been gaining popularity over active investing. This trend can be dangerous in an overvalued stock market because passive investors buy regardless of the value of stocks. When a market correction occurs and selling pressure increases, passive investors may sell indiscriminately, leading to a further decline in stock prices. This presents an opportunity for active investors to identify undervalued stocks and potentially profit from the market correction. Crowding out effect. In a rising interest rate environment, investors can loan their money to the government and receive risk-free returns. This crowds out investment in productive private enterprises, as they cannot compete with the guaranteed returns offered by the government. This can lead to a decrease in investment in the stock market and put downward pressure on stock prices. Debt service costs. Many companies in the S&P 500 are highly leveraged, and rising interest rates increase their debt service costs. As the government borrows more to fund its deficits, it drives up borrowing costs for corporations. To cover these increased costs, corporations may need to raise prices, contributing to inflationary pressures. Conclusion. A rising interest rate environment poses risks to an overvalued stock market. The relationship between interest rates and stock valuations suggests that stocks may be priced too high given the current interest rate environment. The dominance of passive investing and the crowding out effect of government borrowing further exacerbate these risks. Active investors should be cautious and consider repositioning their portfolios to mitigate potential losses and take advantage of undervalued opportunities. As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.